You're watching Master Trader Live, Money in the Markets. Join us live each week on YouTube and see past episodes at Master Trader Live. And now your show hosts, Greg Capra and Dan Gibby.
Welcome, everybody. Today we're talking about fallacies of options. And, this is a great title related to options, but it's related to so many things in the markets and technical analysis. There's so much misinformation out there. It's no wonder that the majorities fail at trading or investing technically. And so the 10 fallacies that we're going to go over today dispels that information, and hopefully, all of these MT lives have a light bulb moment for those of you that attend here. And of course, Dan and I are happy that you all do come because we're here to help. But it's a struggle, and to learn anything that's new when you come to the markets, and when you're vulnerable when you come to learn something new, and most of it is unstructured, what's out there on the internet. And then when you're fed these fallacies or misinformation, it just adds, most of the time, years to the learning curve, which is unfortunate. So let's get to it.
Good afternoon. This is one of my favorite subjects, and I always think of new things as you do your brief introduction there. And this, but many people don't. I started trading options without a clue of how to read charts. Back old Wade Cook 30 years ago, he said, "Oh, just buy stock, sell this, trade the news, Dell stock split, do this." And then I met Greg in New York, and I found out the power of starting with a technical bias and then going to the option tables to I call it a three-dimension, like a Rubik's Cube of what do I want to do? We say options have options. Stocks don't. You either buy it or sell it short. That's it. Another thought I thought of, Greg, we talk about misinformation. Some of it is self-serving, unfortunately, like any industry. They're trying to scare you. They're trying to sell you hidden, recipes to try to line their own pockets and don't care about you. But secondly, I think there's a category in there of ignorance. People say things and that's what ignorance means, right? It means lack of knowledge. You don't know what you're talking about. So we'll kind of combine. It doesn't matter the underlying rationale. The fact is there's many fallacies out there. So let's plow forward here. This is our technical approach. Our viewers have seen this slide over and over again because this is our starting point of trading anything that moves. Whether it's stocks, options, ETFs, commodities, currencies, Bitcoin, a bag of rocks, it doesn't matter. We're looking for a compelling pattern, and then we say, okay, where is this pattern? Stocks go up, down, or sideways, and then there's 4 transitional phases. Where is this pattern? Where is it in the trend, support and resistance, multiple time frames? What are the broader markets doing? So now, we'll get to this in a moment. And then, so once we have that high probability setup, today's session obviously is assuming, okay, I have liquid options. Now I want to trade an option on that compelling pattern instead of a stock. So Greg actually came, he did a quick little artificial intelligence search. We've been playing with that lately. And we just said, hey, let the marketplace tell us what the top 10 ones are. We'll cover the.
So what I did, Dan, just to make it clear, I took the title that you created, and I put in the title, and I said, basically, what would you tell me about this? And it came up with exactly what you talk about with options.
Yeah.
Interesting.
I mean, I'm going to elaborate even more than this, but, just take a quick look. Okay, they're risky. But, buying options is the only way to profit. You need a big account, only for speculation. Are you kidding me? Options are complex. Well, guess what? Walking across a busy street is complex also if you don't know what you're doing. But yeah, granted, trading options is, because of their three-dimensional aspect, it is more complicated than stock. But that's why we have education, and the benefits of what options offer, in my opinion, just dwarf the learning curve that makes the journey more exciting. You need to constantly trade to be successful. That just doesn't make sense to me. Expire worthless, so forth. So let's continue here. Buyers and sellers of options, they have different expectations. So what is a buyer of a put or a call option? Well, we go to the option table, we're paying money, and if we're buying a call option, we have the right to buy the underlying. It's a contract on or before an expiration date and an agreed upon price. So we're long the call if we're bullish, we're long a put if we're bearish. And that can be either for a speculation trade, just as if we're trading the underlying, or it could be some type of hedging, which I'm not going to even talk about. The seller now of that same call or put, they have a different reason for putting on that trade. So I am taking the other side of this long purchase of a call or a put. And in this category, I'm selling to the marketplace that call or put. Why would I do that? We're going to get into that. We sell options to collect this premium based on our technical approach of, we think it's a high probability setup that we're going to keep that premium. That's what we'll get into this. We talked about this. There's just so much misleading information. And
Yeah, Dan, something, sometimes I just hear things and questions as to, I try to think about what someone that doesn't know anything,
right.
what kind of question would they ask? And so you said, you're going to sell that premium. So I was thinking, why is there premium? Why is there that premium, that money that's available out there if you know how to, you take advantage of it, to put it in your pocket?
All right, so I'll answer in two ways. The honest answer is supply and demand, meaning there's people willing to pay for this contract, which gives them the right to buy or sell the underlying. So now let me give you a house example. We're in a bull market in housing, a year or two ago. Somebody walks up to your door, Greg, and says, "Hey, Mr. Capra, will you sign a contract that gives me the right to buy your house at today's market price within the next 6 months?" And what will you say to that person? You'll say, "Why?"
Well, if I think prices are going to go up, I'm going to ask him for a higher price or something to lock it in.
Right. So that's the point I'm getting at, that if somebody is giving the right to take, let's take Apple. Everybody loves Apple. I own Apple. If I'm going to allow you to buy my Apple from me in the next 30 days and agreed upon price, why would I do that? Pay me something if I'm going to give you that right. That's what the market price is for the call option.
Yeah, it makes sense. I mean, I see on a day-to-day basis, because we focus on pre-market giving everyone the levels for SPX credit spreads. And if things are gapping or moving somewhat rapidly in the morning, the direction that they're moving in, the premium gets jacked up. And that's the attraction to knowing what levels, to be selling where it won't get there.
Absolutely. So now we got a high probability setup, compelling pattern. We're going to get into this. We use these two terms. It's a directional trade which is, hey, I want to swing trade this pattern, long or short. So I want to buy calls or puts or a combination thereof, because I want to make a big gain as the stock moves in what I perceive to be a swing direction. So we call that a directional option trade. Income option trade, we'll show you examples. We're just calling it a short-term top or bottom, and we're taking the other side of that option market participant, buying or selling a call or a put, or I'm sorry, buying it because we're selling it to them, but look, I'll show you examples. Then you got to pick the proper strategies. Yes, this is where you need a seminar, because you can't just say, okay, Dan told me to buy a call because here's a bullish setup. Okay, now what call do I buy? That's part of the educational process. We'll give as much to you as we can in today's hour. And then you calculate position size, just whether you're trading anything, manage per your trading plan. Once we're in a position, we're just in management mode. If you're trading stocks, we use bar by bar analysis, pivots, and we use the same technical analysis, technical approach to managing opens as we do with options. But options, there's different adjustment strategies we can use. So that was a little background there. Now let's plow into a bunch of fallacies. Only fools buy options because 85% of them expire worthless and time decay hurts. I think I actually added this part on purpose, and the reason for that is that part's true. When you buy options, it's a time depleting asset. You have the right to buy the underlying on or before the expiration date. So if the stock just moves sideways, that time decay is going to hurt an option buyer. We flip that on its head many times, well, two ways. If we're like, hey, I got a beautiful buy setup on Apple over the high, we buy an in the money call where the time decay is minimal, where it doesn't hurt us. Greg, tell them about your 3-bar rule of why time doesn't hurt us, because we have an expectation of the pattern to move.
The 3-bar rule is something I came up with years ago it wasn't related to options because I traded options, but I didn't know what I was doing in the early days. But the 3-bar rule came about as a way of keeping my focus and objectivity about what was happening, meaning the patterns that we pick, pattern recognition, recurring patterns, they have a high tendency to move in the direction we believe that they will almost immediately. So the 3-bar rule was made to say, hey, things aren't moving. It's been 3 bars. And this, it's a daily chart, for swing trading, a 5-minute chart if you're day trading or whatever time frame you're using. It says, hey, you know what? Did I miss something? Just go ahead and reevaluate, do your bar by bar analysis. And if everything's okay, look, it's just not moving right now, but maybe there's reasons to think you should reevaluate. That's what the 3-bar rule is about.
Right. So that time decay, what little time decay we experience as an option buyer using our technical approach is dwarfed by the benefits of leverage and limited liability. Whether you buy a call option or you buy Apple Computer at $179, your max loss is whatever you pay for it. But paying $179, even with 2-to-1 overnight margin, is tremendously higher than if I can buy a $3 call option with 2 weeks of expiration. So that's why we trade these. And the third reason I talk about is, let's say my buy setup on Apple fails and I take my stop loss like a good trader, like I do. And if I stop out of my long call, the majority of the time, I'm going to lose less money on my long calls than you are being long stock. So nobody talks about that one, but I do. So there's three amazing benefits to buying options. 85% expire worthless. It's just an incorrect noise. It's just not correct, number one. And number two, many people, because of the different reasons of buying and selling, they may want them to expire worthless, because that was part of the reason they put on the trade as a partial hedge. So it's just a retardedly misleading statement.
And people that, there's, as you know, there's many out there that don't even look at a chart. So they have no idea of the probability that that stock or ETF or whatever you're trading is going to move. And if that moves in a specific period of time, that option has to go up in value. So
You know what, Greg, where I actually think this statement came from is they're talking about the novice traders who only buy far out of the money calls that are cheap, because they're trying to go for the home run. And it's what you've experienced when you were buying OEX options decades ago, that even if the stock goes in the intended direction, it's not going to the strike price that you bought, and it expires worthless. And you're like, wait a minute, the stock moved and my option didn't. It's because you bought the wrong strike price and expiration problem.
Nothing wrong with buying something a little bit out of the money that's cheaper if you can read a chart.
Correct.
Come to a conclusion that, hey, this thing's likely to be in the money relatively soon. And you see what happens.
It doesn't have even to be in the money, as you know, Greg, because let's say it moves $10 on whatever expensive stock. It doesn't have to be in the money, but it's still going to go up in value, because it's the delta's higher. I don't want to get too complicated. So here's an example of buying a put option that we gave our subscribers. This was the advisory swing and options letter. This is a closed trade, directional trade. We could have either shorted GNK, but we bought this put. Look how simple our daily charts are. Red and green candlesticks, color-coded volume. We use the 20, 50, and 200 to help speed the analysis. Notice all three of these are down. So in Greg's course, we teach how to read candlesticks, patterns, trends, support and resistance, everything. But this is a downtrend. So then we teach you, here are the tools of how to profit in downtrends. This is one setup of ours, a sell setup. This is a multiple bar turn reversal below the 20 in a downtrend. We could have bought these puts under the low of that bar, but I didn't see it at the time. I saw it over here.
Yeah.
So we could have shorted the stock, but because of the benefits that I just reviewed with you, leverage, limited liability, and my loss is less if stopped out, I always prefer options if they are liquid. So we bought an in the money put. I'm throwing a lot at you. You'll have to go back and watch this again. But by buying in the money put, this means I have the right to sell GNK at $15 a share on or before June 16 expiration. As it moves lower, as the chart suggests, the value of my put that I paid $145 a share goes up in value. Because now the stock is way the heck down here, but I have a contract. I can sell it at $15. So options are what we call their derivatives. They're derivatives of the underlying. Calls are going to go up as the stock goes up. Puts are going to go up in value as the stock goes down.
So just for those that don't have some knowledge of options, I marked off $15 is about here. So the stock was trading at this point. So this was in the money.
Right.
That's right. The strike price was in the money, whereas someone might say, hey, you know what? These ones, I think it's going to go down and I'm going to buy the $13 ones
Yep.
that are cheaper. But by
Yeah.
the time it got to potentially by the time it got to $13, your time premium would have decayed and it could be at $13 and you lost money.
Right.
So the options that are more expensive, if you get the direction right, are going to increase in value. Now, sometimes depending on what your depending on the chart pattern, you might say what a setup like this, it's like, you know what? I'm gonna buy the ones that if those strikes were there, let's just say $13.77. That's what that 20 MA is. They're probably not an option strike at that price, but anyway, you say, you know what, it's trading at 14, but I do believe it'll get to 13.77. So I'm going to buy those little bit cheaper options because I believe it's going to go down here. Everything's based on a belief. So when we look at charts, it creates beliefs about the future. And then how are you going to take advantage of your belief? That's what technical analysis is.
All right. So John asks, hey, well then, should I always buy in the money call and put? Excellent question. In my seminar, I say, just as a vanilla rule, as a swing trade, which this is, I like buying 75 to 80 delta, which is in the money. And I just find that's a nice compromise between I'm going to get paid, meaning dollars. I'm going to get paid for my directional bias, and I'm not going to get hurt much by time decay. But as Greg said, we also teach when to buy at the money or out of the monies because we're wanting a cheaper price. And we think this thing has the potential to make a big move. And that's where we call it, like an intelligent home run. I have a late date breakdown I'll show you here shortly, which is a good example of that. Let's continue. We got a lot of great information as always. Here's old Warren Buffett. Only fools sell options because the potential risk dwarfs the potential gain. So think about that. I'm taking the other side of the option call or put buyer and I'm selling it to them. Well, I'll show you a chart, and that's a ludicrous statement if you use our technical approach. Yes, the textbook, the potential risk to reward is dwarfed. So for example, if I sell a $5 wide put spread on Apple for 50 cents a share, my maximum loss is $4.50 a share. My maximum gain is 50 cents a share, the credit received. That's a true statement. That's a textbook proper answer. But I think that's such a novice view because if I were to buy Apple at $179 a share, my textbook answer is I'm risking $179 a share. It's my textbook answer. Whatever you pay for it is your maximum loss. But we use the same technical stops on whether we're shorting options or buying the underlying. So it's all about the probabilities. Secondly, is that if you don't mind owning the underlying stock for fundamental or whatever reasons, I don't care what, selling puts to acquire stock at a cheaper cost is 100% no-brainer benefit trading. You're buying something on sale that you want to own. So that's selling options. So when we do these as a speculative trade, we use our technical approach. and we say, I don't think it's going below this base, this support in X number of days. And then I have my checklist. How much are you going to pay me to take this risk? Make sure the spreads are tight, no pending news. We teach all this in the course. And this melting ice cube that I told you about that hurts the option buyers is our profit. Another fallacy. When you sell options, the premium received is 100% profit. So, you know, remember in the intro, Greg, I said some people, they're snake oil salesmen or they're ignorant or both. This is a beautiful example of that. Look, these two were real quotes that I got from competitors. This income is an on demand, which means you can essentially write your own monthly paycheck. Remember the slide we went over about buyers and sellers of options? When we sell options, we have an obligation. It's not free money. You haven't earned anything. If you go to close that trade 3 seconds after you put it on, you're going to close it at a loss because of the spread, small little spread. So this guy, Chuck over here, you may not average $72,000 a month like Chuck does. See, this, you just want to puke when I see this. You know, I got a bridge to sell you, but you can easily expect to make 10 to 12 bucks to 12 grand a month because every trade's a winner the minute it's placed. Greg, you want to respond to that?
It's a crook.
It's mind-boggling bullshit. And it irritates me. What can I say? We obviously stop out of trades at a loss when the technical pattern fails. But look, it's a contract. You have an obligation for that premium you took in. This is another fallacy. There's some traders, you know, with the Greek, these are the Greeks right here. So they change in value with direction, parentheses, that's the Greek delta, the melting ice cube, time decay, that's theta. And look, volatility goes up and down, right? With the VIX, that's called vega. It's explained in the course. We only have an hour together, so I can't cover it all. But what we call, or they call themselves, the mechanical option traders, who don't know how to look at a chart, they say, oh, a 30 delta means that's the probability of it expiring in the money. So Greg, I'll let you take this one. Do you think a 30 delta call and put has the same probability of success after this igniting bar to converging 20 and 50? And then you can do the opposite on this one.
Clearly, the big green bar says it's going to go higher, gap lower and reversed. So buying a put would be, well, be a sure way to lose money. And if you sold it to somebody, high probability you're going to keep that money.
Correct. So they would look at the option table and they would say a 30 delta call has the same probability of success as a 30 delta put. And that's what Greg and I are saying. As a technician, with using this pattern, you're an ostrich. You got your head in a hole if you believe that. See, the option tables, I say that they're chart agnostic. They don't move based upon a chart bias. They move based upon this Black-Scholes model. And so that's why if you don't use charts in your trading, unless you're a high frequency, you know, gamma scalper in Chicago or New York, or, you know, working for Gecko or Citadel, then you're an ostrich. Buying or selling short-term expiring options is incredibly risky. Some people teach you better buy 45-day or longer options. So you have time to react to what's going on. And they say, oh, this risk of gamma, which just, measures how fast the directional risk is moving. If you walk across the street blindfolded and don't look left and right, then yeah, I guess it is buying and selling short-term is risky. But let me show you one or two examples to just convert, which is a subject of today, convert this fallacy into profits. So here, recent trade. Greg, remember in the trading room today, we were talking about proper breakouts from consolidation or continuation pattern. We don't buy breakouts from the bottom to the top. So this is a beautiful initial breakout. We bought deep in the money calls. Why? Well, we've covered it a little bit already. Because I want to get paid for my directional bias, and I don't want to pay a lot of time premium. So instead of buying the stock at $15 and change, we bought these calls for $2.30 a share. We always give the technical setup. Here we go. In one day, we made 41% in one day. Move the stop, going in a trail mode. In these 2 days right here, we made 81% return. And this was the option expired in 2 days. So Greg, I thought you just told me buying short-term expiring options is incredibly risky. Why is it risky if I'm only paying 2 cents a time value and I'm getting paid for my directional bias?
That's the advantage of using the chart, because you can see, clearly it was in an uptrend and it went sideways, and there are tells there, that bottoming tail bar dipped under support and it went up, and this gap down turned into a green bar, and this attempt to go down came right back up again, and then it took out the high of a red bar. When we did gaps last week or the week before, one of the 7 points of the gaps was, was there a shock? So, well, that's kind of what I'd call a minor shock, but that red bar was followed by a gap down reversal. So clearly the demand was very strong.
Yep, we bought this over this red bar. Exactly. All right, so John, you asked me earlier. So here you could buy at the money put, out of the money put. This is daily chart on the left. I don't know what the stock is, but it was at all-time lows from a recent IPO. This is what we call a master trader late day breakdown. Open the day flat. This vertical line obviously is exchange of day. Wide range bar. Inside bar, that's what's called a bearish 1, 2, 3 continuation. Could we have bought the put option under this as a bear 1, 2, 3 day trade? Without a doubt. Guess what? I didn't see it. I got 6 screens, but I can only follow so much. But I found it in the morning. And then I told subscribers, if this bases near the low, it's going to be a beautiful candidate for a late day breakdown. Look, it was at all-time lows. So right, that closing bar, that's where we bought this put. So unless it's going to expire that day, we can buy short-term dated out of the money options as a late day breakdown pattern like this all the time. Because if we only think we're going to be in the trade an hour and it expires in 1, 2, 3 days, the time value that I lose in 1 hour is immaterial to what I think I'm going to make on my directional bias.
Can't do it without a chart.
Right. And
I mean, that's part of the reason why a lot of these option services say, oh, you have to do options 30 or 40 days out, which I didn't get until I heard them say it one time, because what was the reason? You have to give it time to work out, which they have no idea. If, they have an idea, they have a belief that it'll work out, of course, or they wouldn't do the trade, but they have no idea any kind of timing. So when you look at a chart and you look at multiple time frames and you see, oh, the trend is down, and you see a situation like this where, it couldn't go up. It fell hard. It formed a little bottoming tail bar, and where it attempted to go up, it failed.
Over lunch.
And over lunch, and most times it usually happens around 2:00, but not always. Sometimes it happens before, but around 2:00, 2:15 is the time that you really want to start paying attention. And
Yep.
sometimes, like this one, it happened when it happened.
Yeah. So fallacy, don't, so we just covered fallacy, don't buy short-term expiring options. And I just proved to you that's ridiculous if you know what you're doing. Here's an example of don't ever sell short-term expiring options. Well, guess what? We specialize in shorting short-term dated options. In fact, our weekly options trader only sells options, naked or spreads, that expire 10 days or less. This is a specific trade of ours where we sell 0 DTE options. So the index options have multiple expirations, which we love because it sets us up to do every single day. In fact, we did a beautiful one on the Qs yesterday with the gap and crab. So all we're doing in this strategy is looking for a point in time where it looks like a higher low for the day. We go to the option table. What are you going to pay me to take this risk? Put it on, manage in between. So this spider daily gap down. And these dotted lines are pre-market. So you see the big gap down here. It rallied into the open. And look at this. It just chopped around all the way until 11 o'clock and couldn't get above this pre-market resistance. So right where these arrows are, we shorted an out of the money call spread, expired that day. If you sell 10 of these contracts, 51 cents a share, just times 1,000, $510 is immediately deposited into your account. Remember what Chuck said a couple slides ago? That's immediate profit. I showed you that's 100% horse manure. It's not pure profit. It's premium that hit your account that you have to manage. But it is pure profit at the end of the day if it closes below this short 286 strike, which it did. 286 is way the heck up here. All right, we're dispelling all kinds of myths here today. If you want to see us implement what we do in real time, our green trading room is fantastic. I'm not sure if Greg posted a link here, but I'll mastertrader.com/green trial. We start at 9 a.m. pre-market review, hit list, open positions, gap trades, and then we're trading live, scanning, answering questions. It's a fantastic venue. Next fallacy. When selling options, you should roll the position instead of stopping out. Greg, I remember 25 years ago, you and I spent probably an hour defining what a stop is. Do you remember that conversation?
Yeah, I do. We were sitting in the Miami office.
So read every word of this, folks. you know, a stop could just mean, oh, you get out of the trade if it goes under that, prior pivot. And so Greg and I talked for an hour for it to internalize. It's predetermined line in the sand where we are determining that the reasons for entering the trade, they no longer exist. So we exit the trade to preserve capital and your mind. Those that don't do this and get caught up in, oh, well, I'll roll it and try to get bailed out. That's what this guy's doing. Have any of you dug a ditch and you just make the problem bigger? Greg, I went and got this for you. So this was a put spread we put on. I told you we take stops. Anybody who says they don't have losing trades, they're the horse manure. So we sold a put spread here. It went sideways. So when it went sideways, we were actually making money through the time decay. Remember the melting ice cube? But here we stopped out. This wide range bar sliced through support, we stopped out. Those who say when you're selling options, don't take your stop. Just roll it to the next week or month or whatever your rolling strategy is. This is what can happen to you. So let's just say we stopped out at 180 using round numbers. Well, the thing went to 140. So now you're at max loss. And another problem with rolling spreads that aren't supported by the technicals is the more it goes against you, hence the fire bail rolling down the hill, is that you have to roll the position, not taking in more money as a credit, but you have to pay more money. So you're making that hole you dug yourself bigger. You're making the loss potentially bigger by not stopping out if the pattern fails.
Unless it moves in the direction you thought.
What we're talking about selling options though, right? So Greg, why don't you take this one? And then this is the last one.
Best way to make money, trading options to purchase far out of the money options. Well, that's what we were talking about before.
Right. We did cover it.
Buying cheap options is a poor man's game, trying to make a return on a small investment. Hey, so if you have no concept of how a particular instrument might move, but you believe it's going to go up or down, and you just buy something out of the money, which, look, you may not even understand what out of the money means, but you just see these strikes. I mean, let's be real about where many of us start out.
Right.
We're just on the money, and it's like, oh, that option is 50 cents and that one is $3. So that one for 50 cents, you believe that it's going to go up in value the same way, but it's not.
Right.
It's just not going to happen. So, but if you get lucky, we're not here to get lucky. It would be great to have luck, but if something does make an explosive move, yeah, your 50-cent option can turn into $3, and that's a hell of a windfall. But
Like
the probability of that happening isn't very good.
So, the Elder was a great psychology trader type in the 90s. He had great books. And I love this statement from him. He said, people buy hope out of the money call option. So the option market prices that hope and fear. So when volatility rises because people are fearful, the prices of these options get inflated. And so we use our technical approach to sell these inflated price options into greed or fear, but at the right time, not blindly. When Nvidia gapped up 100 points, whatever it was, my bias that day, 30-minute low, short a call spread. It was like $4 or $50 away. It was crazy. Inflated prices because of greed. When we get multiple day sell-offs, and then we have all our internals, we go on a field day selling these inflated puts with the pattern. Last claim, and this one actually is true many, many times, and that's why I'm ending with this one. And this is one of our subscribers. This is his email to me. Roger, I made money and the stock went against me. How is that possible? Well, we've covered it, folks. It's on selling options. This is our weekly options trader. We're selling an option, a put spread, for example, under support. So the stock can bobble around sideways, it can rally, and it can go against me. As long as it doesn't close below my short strike, I still made money through the time decay. And that's what Roger said here. I made money and the stock went against me. This is an absurd strategy. But you have to do it with a technical approach. Go to mastertrader.com/spread trader if you're interested in these option strategies that we've talked about today, both selling options for income. We have two great courses here. This one's very comprehensive, 12 module and covering every situation you can imagine. And then the directional course is start with a technical pattern, as we talked about. Now I go to the options table. What do I do? That's what this course is all about. But amazing benefits, as we've illustrated over the last 49 minutes. So let's now, as always, Greg will pull up his charts. We'll answer any questions you have, look at the market, see if there's any option trade we can consider into the close or next couple of days.
And what Charlie M is saying, of course, is correct. I mean, you're closing that trade, and not only, the difference, you're closing and opening up a new one, but you're also paying commissions. So yeah, I mean, you did lose money, but you rolled it into another dated option.
Well, and also just to add to that, Charlie, I am not adverse to rolling if the pattern supports the original bias, and if it can be done at an additional credit, which is improving your cost basis. Now, by definition, Charlie, if you have to roll at a debit by paying more money to stay in this losing trade, that is telling me that the trade is so far against you, you're in hope mode. And we don't like trading in hope mode when we know the chart pattern failed.
Yeah, that's an excellent point, Dan, because people that roll without charts, they really don't have an idea. They know it's not working in the moment. Whatever beliefs they have that it will work, I don't get that.
Well,
weeks, but
you have a saying intelligent hope mode, but that's still technically based. It's not an obvious. This thing just blew through 3 levels of support, and the sector's going down, and the market's going down, and you're going to Yahoo Finance looking for reasons to stay in this losing trade.
I would say the reason that we would consider rolling, and is what you're saying in a different way, is the chart pattern hasn't fallen apart, but our time premium has expired. And so now we're rolling because we still believe the chart is still valid.
Correct. Correct.
But we're at time.
Correct.
Yeah. All right. So I just threw this up here. This is going to report earnings after the close. I don't know if you looked at this, Dan, as far as an options trade. Because you and Sam and some of the others in the chat room do a lot of these option trades because the premiums get so jacked.
Right. So go through the mental checklist. What's your bias on this pattern? I know but
extended, but it could become more extended, right?
well, correct. So my bias is short and out of the money call spread, depending on if they're liquid and how much are you going to pay me. So let's see how much they'll pay us, and then we'll continue the discussion. Go up
So-
to like 60.
Yeah, I'm scrolling down because, here you can see $60 is 70 by 75. And
Now,
You
see,
know,
I would want to do a spread, so I'm just eyeballing there. If I did a $5 spread, see, the green room, you hear me saying, if all the levels are expensive, you're not going to get a good net credit doing a spread.
right.
So $5 wide, there's not going to be enough. So I'd rather, Greg, wait for earnings to come out. And then, we love trading options after the earnings come out, because then we don't have the gap risk.
Right. Right. So I'm just looking at the puts to see if there's how far below. And you can't get that far below.
Yeah, it went too vertical is the problem.
Yeah. So we asked about NVIDIA. You can see the question, NVIDIA for 1 month plus trade. So you didn't say, are you sure? Well, for a month out, what do you think this is going to do? It's
Right,
got a
what's
huge
your
trade
bias?
below.
You got to start with a bias. You don't walk into the doctor's office and say, fix me. He's going to say, what's wrong? What's your bias? And then we can talk about the strategy to meet your bias.
So it would to me, it would make sense to be thinking about doing a call spread.
Absolutely.
And if you went out to next week,
Yeah.
it's 400. I always look for something ridiculous. So I'm looking, in a whole number, but there's no premium there. And then you just start scrolling back. So 455 is 90 by 94. Do you feel comfortable at 455?
But it's the same problem with trying to get a net credit, I think.
Yeah. Yeah. So not every chart is going to offer you the ability to do a credit spread. So you have to look at the chart, so you get a bias. You go to the option table and look. It could come down a lot more, and if and so now, would you want to buy a put, say for a 370 put expiring in next week? So you got to believe something is going to happen, and the market looks like it's topped out. That was the theme this morning pre-market, that it's a short-term top, even in yesterday when it gapped up. And today's theme was the gap is confirming the bias from yesterday. And so if you bought something slightly out of the money, and I don't have my delta on here, Dan, so I don't know what that is, but this is something that could easily go below $370.
Mm-hmm. Sure.
CRM earnings, or I don't know what that means, AMC. This is going to report earnings tonight, I guess, after the close.
It means after market close, I think.
Yeah. So go through the same thing. I would think even if they come out with good earnings, it's probably already into the price. And so these are earnings trades versus just a pattern trade that we'll be talking about during the MT Live. So I'm just scrolling to see how far is their premium. So this being at $1.272, that's 50 points away. And if you did
Wow, 272. I like
270.
that. 270. I like that.
Yeah,
Wow.
you can get enough juice there to do that. 50 points away.
So come into the green room. We'll do it. We look at all earnings trades starting around 3:00 in the green room, but I'll put it on the list.
Look at the weekly chart. That's way up there.
Yeah, absolutely.
That premium is really jacked.
I like it. I like it.
Okay, there you go. So this is just looking for things that are active today.
Oh, wait, Greg, one caveat to that. Was that 36 days to expiration that you were looking at? No, never mind. I see 2 DTE. I saw something 36 days. Forget about it.
No, not
2
on
DTE.
2. Yeah. Sam's saying OKTAs today. So that's what this is here. That's going to report today, and the same process. Just to see where there's enough premium. And 110 is right at that pivot. So that would be huge. 110, and how far away you could get 110. I guess 10 wide I'd have to add more, but that could be considered, sure.
But Sam is suggesting 75 put also, so just for other people's edification, we do that sometimes. We do condors. We go way the heck out of the money call spread, way the heck below put spread. And we did one last week on Dollar Tree or something, I forget, but worked out really well.
Yeah, and it's got support. So if you're going to sell a naked put, if this was down here, there's a gap fill, there's going to be buyers down there. And probably bounce back up. And Dan, I've seen you do these things and some of these gaps, and you make money, and it goes against you with just because the volatility crushes what you mentioned.
Exactly right.
So yeah, options are more complicated if you don't understand them at all. I know it was for me.
No.
To get your head wrapped around the terminology and the time decay and premiums and this and that. It takes a little time, but that's what the courses are about.
Right.
And once the course, and look, one of the things I said, Dan did a live coaching session last night. Anybody, if you sign up for the weekly options trader or anything today, a course, you sign up today, I'll send you Dan's coaching session, which is going to go out to students and subscribers a little later today. So consider it, and we'll be back next week. You can sign up for the next week if you want at the site there. All right, we'll be back then.
Keep trading on.
Thank you for listening to Master Trader Live. If you liked the show, we invite you to share this video on your timeline or tag a friend who wants to learn stock market tips. Stay educated with our free chart of the week, a weekly analysis or lesson sent right to your inbox. We're live every week, and you can subscribe to the channel and press the bell to get alerts. If you've enjoyed the event, please give us a thumbs up. Just visit mastertrader.com. That's mastertrader.com.